In a previous video, we were SeaWorld and bought Arco, the killer whale. Management of SeaWorld had estimated that their whale that they bought would last for 10 years, and in those 10 years, it expects to get 8,000 performances. At the end, management estimates that they'll get $10,000 at the end of the whale's useful life. Residual value is also called salvage value, so those terms are interchangeable. This is information we actually don't need for this video, but will for another one, and that just basically tells you how much the whale performed in the first 2 years of its life. So if you can recall, in the previous video we bought the whale and we had to include all the costs to get the whale in place and ready to perform or ready to use. So that was a total of $630,000. Now if you recall, long-term assets other than land depreciates over its useful life. So then in this example we need to depreciate this whale as we use it, because as we use it we're going to generate revenues by selling tickets for these performances, and we want to match the expense of using the whale with the related revenues that will make shareholders' equity go up. Well, the amount's going to depend on which depreciation method you use. You have a choice as a company. You can pick one of, actually there's more than 3, we'll cover 3. This method that we'll cover is straight line method, and it's straightforward in that you just take your what they call your depreciable base, that's your costs, 630, minus your salvage value or residual value, i.e. what you think you're going to get for that asset when you're done using it. Then you divide it by its estimated useful life to get an amount of 62,000 in this example. So the idea behind a straight line is the amount of the expense is going to be the same year after year. We're going to expense 62,000 each year. The entry you make is you debit depreciation expense and you credit accumulated depreciation. We don't credit the whale account, we leave that whale account at its original cost. The accumulated depreciation will be booking that or posting that there. If you look at this together, the whale and the accumulated depreciation will be netted together on the balance sheet, and their net will be the 632,000 minus the 62. So what will be on the financials, what's on the income statement, you're going to have the depreciation expense along with the revenues that we don't have recorded here but would be there. And on the balance sheet you're going to show what's called the net book value of the equipment. Well, not the equipment, this is going to be whale, and it's going to be the 568,000. The statement of cash flows is going to show under investing activity. Remember, cash flows, investing activities is cash paid to buy long-term assets, which are actually called capital expenditures, and the amount was 630,000 of cash. Now, depreciation expense, this is actually, it's a temporary account, as are all your revenues, expenses, and dividends. So that's going to get closed into retained earnings at the end of the accounting period. So this will become zero. So when we start next period, there will be no beginning balance. The beginning balance will have reduced the beginning retained earnings. Accumulated depreciation, on the other hand, though, that is a permanent account, and so as a result the balance in this account will accumulate. It doesn't get closed out, so it's going to equal all the depreciation to date. That's unlike the expense, which gets closed out and is only going to show the current year's depreciation. So when you go to year 2, like I said, this is going to get zeroed out, so that would be part of retained earnings, which is under here. I'm just not showing it. Now we go into year 2, you're going to make the exact same entry, okay? And you're going to post another 62,000, right? And you're going to expense 62,000. So that is going to represent your amount of usefulness used in year 2. As far as what's going to show up on the financial statements, your income statement will show 62,000. Your whale account, here, let me fix that, sorry. The whale account will have an accumulated depreciation of now $124,000, so that your book value will go down by that 62 and will now become $506,000. And there will be nothing on the statement of cash flows, because in that second year there is no cash being paid. In fact, depreciation is called a non-cash expense because it's not one that gets paid. So again, to summarize, your income statement will be $62,000 each year. The cost doesn't change. That remains at the $630,000. And then the accumulated depreciation accumulates. Oops, sorry. And that will be $62,000 in the first year, $124,000 in the second year. And that'll continue on. So you can see here the book value gets smaller and smaller as the usefulness of the whale is used.